There are two main classifications to understanding when investing in different countries. There are developed markets and there are emerging markets. What is a developed market, you ask? By definition, a developed market is a country that is mostly advanced in terms of its economy and capital market. The country must be high income and open to foreign ownership, allow for ease of capital movement, and have efficiency in their market institutions. As of 2021, Standard & Poor's classified 25 countries as developed markets. The United Kingdom, Hong Kong, Australia, and Japan are just to name a few. Developed markets are considered more stable markets, and it is important to note that although the U.S. economy is one of the biggest in the world, it hasn't been the fastest growing when compared to other markets. So what is an emerging market? An emerging market is a country characterized by rapid economic growth and development with lower per capita incomes and less mature capital markets than developed countries. A formula using a country's gross domestic product or GDP and per capita income is used to determine if a country is an emerging market. Some countries that are examples are Brazil, Russia, India, and China, also known as BRIC in the financial community. And like with every investment, there are benefits and risk involved with investing in emerging markets. Some advantages of emerging markets include high growth potential due to the rapid expansion of the economic environment, diversification, a good diversification tool for your investment portfolio because an economic downturn in one country can be offset by the growth in another country. And some risks of emerging markets include political risk. Emerging markets may have unstable, even volatile governments. Economic risk. These markets may often suffer from insufficient labor and raw materials. And lastly, currency risk, also referred to as exchange rate risk, arises from the change in price from one currency in relation to another. So in summary, understanding the differences in developed markets and emerging markets can help you to properly diversify your portfolio. And as always, it's a good idea to first understand your financial planning strategy and risk tolerance before investing.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.